Hello everyone, this is Rajnish and I welcome you all to Bulbust Capital's another video. Today in this video we'll know what is pre-open market and how it's calculated. In this video we'll capture three major sections of this pre-open market. One is what is this pre-open market and what is its importance. The second is how is this pre-open market calculated and how does it work. And third thing is who can trade into this pre-open market. So let us dive deep into each of these sections in the video. Come, let's go. So coming on to the first session of this video, that what is the pre-open market and what is its important. See, the pre-open market is necessary to minimize the volatility and to discover the opening price for the underlying securities. See, this is done only for the equity segment and done between 9 a.m. to 9:15 a.m. See, this pre-open market is very much necessary and the pre-open price is very much necessary to keep the volatility under check, order flow, and the liquidity into the script. Imagine a script without having a proper opening price. What could be the conditions of the order flow, the volatility, and everything? That could be a very disaster for the demand and supply into the script. To keep all these into equilibrium, a proper equilibrium price has to be determined, and that is done into three phases. The first phase is from 9 a.m. to 8 a.m. This is the order collection phase and the order modification phase. And from 9:08 a.m. to 9:12 a.m., that is 4 minutes of window, will be for the order matching. The third phase will be the 3 minutes of last 3 minutes, that is 9:12 to 9:15, where this is a buffer zone for the market to have all the orders matched and coming down to the conclusion. So we'll discuss each and every part into the details of these sections, that is 9 a.m. to 9:08 a.m., order collection, order matching, and buffer zone. So let's dive deep into each of these details. So coming on to the second session of the video, how is pre-open market calculated and how does it work? See, the pre-open market calculation has three phases. One is 9 a.m. to 9:08 a.m. is the first phase. This is called the order collection phase or the order modification phase. The second 9:08 a.m. to 9:12 a.m. is the second phase where order execution take place. The third phase is 9:12 a.m. to 9:15 a.m. which is a buffer zone. And this buffer zone is kept for a smooth transition of the pre-open market to the actual trading hours. So coming on to this first phase, that is order collection phase, which is between 9 a.m. to 9:08 a.m. Here all the buy orders or sell orders are listed. Any modification to the existing orders can be done. Cancellations of order can be done. All these orders are taken into place, and between 9 7th and 8th minute of candle, the anytime the session can go into the order execution phase. All the orders are fed into the system to find out the maximum tradable quantity for that particular strike price. Suppose an example, consider Nifty into the scenario, many people have bid for the 20,500, 20,600, 20,650, 20,750. Buy orders, sell orders are placed for all the strike prices. The system what has taken the orders for from 9 a.m. to 9:07 a.m. that is sent into the execution phase, the system will try to find a proper equilibrium price where maximum tradable quantities are allowed. Say for example 20,650 is the maximum tradable quantity and rest others are less than that one. For example 20,650 has 5 lakh tradable quantities and that becomes the open price for the session. And say 20,700 has only 4,80,000 tradable quantities, so that is not is an open price. So 20,400 also has 4,98,000, so that is not an opening price. Opening price is at which strike price at which has a maximum tradable quantities. It means where buy and sell can take place at particular that strike price, and that is the most highest tradable volume. That is considered as open price for the current session. The third is buffer zone. Once this pre-open market price is determined, that would be the open price for the current session after 9:15, and this buffer zone is kept for any technical glitches or any modification to the systems, any such scenarios where something could go wrong and this arrival of this opening price is delayed. In such a scenario, this buffer zone is used. Usually by 7th to 8th minute itself, the opening price is decided because all the orders are fed into the system. The system is so capable and so quick that the equilibrium price is instantly identified and it is displayed and it is already marked out. So only for the technical specification, this 9:08 to 9:12 am is an execution phase. Such a long 4 minutes of Execution phase is not there. Actually, it takes less than 30 seconds to get the opening price displayed. Usually we see somewhere around between 7 a.m. 30 seconds to before 8 a.m. the pre-open price is determined. As usual, as discussed, the remaining price would be remaining time would be from 9 a.m. to 9:15. That could be a buffer zone for any technical glitches or anything which could go wrong, and that could buy more time. So that is all for the buffer zone. So as we have understood, the three phases, one is the 9 a.m. to 9:07 a.m. or 9:08 a.m. where the orders are collected, buy orders, sell orders, modification, everything is done. In the execution phase, what happens? All the market limit orders are matched with the limit orders, and all the ineligible limit orders are matched with the market orders. And third, all the market orders are matched with the market orders. This is the way it is opening price is determined, and this calculation we will discuss deep into the third session of the video now. By we will have a pictorial representation how this the price is determined. So let's get deep into it now. So coming out to the pictorial representation of the second session of the video, that is how is pre-market calculated and how does it work. So as we have seen, as we are seeing in this pictorial representation, that is chart representation, this is an example of Nifty spot price, and on the starting from the heading, this is the price structure, strike prices, where 23, 400, 455, 500, and this is the strike price followed, and this is the order book, and this is for the buy order, sell order, and the demand and supply. And demand and supply, this is the quantity over here. Demand and supply in the sense, this is the quantity, and this is the orders, number of order, and this is the quantity, and this is maximum tradable quantity, and this is unmatched order. See, let me explain this chart. How does it see? As we know that from 9 a.m. to 9:08 a.m. all the orders are sent for execution phase. All the orders which are collected and modified, they are sent to the exchange for the execution. In the after this 9 to 8 a.m. all the orders which are sent to the execution, these are sent to the system, and all the orders are captured in such a way that every strike price, buy order, and sell orders are mentioned here, and the demand for each and every strike price is mentioned separately. For example, 23,400 buy orders, there are 1100 buy orders, and the sell orders are 1085, and the demand at this strike price for the quantity is 4000 quantity, and supply is 2500 quantity. It means there are 4000 quantities buyers are ready to buy, and suppliers are having only 2500 quantities to be sold. Means you have 15 books you have 15 books to be you have 15 books in demand to purchase, and I have only 10 books to sell. It means the demand is more and supply is less. So what is the tradable quantity here? Because I have only 10 books to sell and you have demand for 15 books, so only 10 books can be sale transaction can be closed, because the demand and supply is matched by only 2500 and this thing 4000. Only the matched quantity is 2500, remaining is unmatched, 1500, sorry. So 1500 is the unmatched order. So supply of 2500 is fulfilled by the 2500 demand, and the remaining is the 1500 unmatched order. The same way, 23,450, it has 1400 buy orders and 1360 the sell order, and here the demand is 4600 and supply is 4000. It means supply is short by 600 and demand is more by 600. What in turn happens? 600 will be the unmatched orders. 4000 demand is matched with the 4000 supply. 600 is the unmatched order. In turn, the same thing, 23,500, what it happens here? 2000 is the buy order and sell order is 1800 sell orders, and demand is 5000, and 6500 is the supply. It means supply is more and demand is less. It means you have 6500 units to be sold, and but there is only demand of 5000 orders in the market. So you can supply 5000 orders to the market and it gets executed, and 1500 will remain with the seller. And what is that? That will be a minus 500 unprocessed or unmatched orders. The same way followed by all the strike prices. So how is this opening price determined? See, the price at the strike price at which maximum tradable quantity is available is the opening price for this session. So in this scenario, you got to know what is the maximum tradable quantity. What is maximum tradable quantity? So whatever the price, demand and supply is met, that price is called maximum tradable quantity. And what is the demand and supply here? 7000 is demand, supply is 10,000. So supply is more. So only what is the tradable quantity here? 7000 can be tradable. Remaining 3000, there is no buyer for that one. If the supply is more and demand is less, whatever the demand is there, that becomes the maximum tradable quantity. If the demand is more and supply is less, what happens? Whatever the supply is the quantity, that becomes the maximum tradable quantity. Okay, for each buy order there has to be a sell order, then that becomes a maximum traded quantity. If such things happens, what is here? The 7,000 demand is there, 7,000 supply is there. Yes, because more than 7,000 we have supply, so 7,000 becomes the maximum traded quantity, and whatever the remaining 3,000 quantity, that becomes the unmatched order. Okay, the same way all the strike prices here, the what is the maximum traded? 2,500, 4,000, 5,000, 3,600, 7,000, 5,500. Here we have the 7,000 as the maximum traded quantity, and what is the strike price? 23,600. So 23,600 becomes the strike price for the opening session. Okay, and you might have a doubt, sir, what happens in a scenario where two strike prices have the same traded quantity? Yes, you're true, and that might happen in a regular sessions also. Let me explain in that one as a detail. See, here in the same followed scenarios, like we have already Nifty price level 23,400 to ending with 23,650, and here we have two strike prices having the same traded quantity. 5,000 is the maximum traded quantity. Here also maximum is the traded quantity. What had happened? Demand is 5,000, supply is 7,000, and the supply is more, so 2,000 is the unmatched order. Here demand is more and supply is more. Demand is 7,000 and supply is 10,000. Here also what has happened? Supply is more and demand is less. Here 3,000 is the unmatched order. I'm sorry, here 9,500 and 5,000. What has happened? 4,500 is the unmatched order. But what is the traded quantity here? 5,000 is the traded quantity. So how do we decide now? Both 23,500 and 23,650 has maximum traded quantity. But in this scenario, what happens? The least number of unmatched orders becomes the opening price for the current session. And what is the unmatched order here? Maximum traded quantity is same, but the unmatched order for 23,500 is 2,000 quantity and 23,650 is 4,500 quantity. So what is the least number of unmatched orders? 2,000 is the least unmatched order. Between 4,500 and 2,000, 2,000 is the least unmatched order. And what is the strike price for 2,000? 23,500. So 23,500 becomes the opening price. So this is how it is determined when both the maximum traded quantities are same. And there must be one more scenario where maximum traded quantities are same and maximum unmatched orders are also same. What would happen in such a scenario? Yes, there is also a solution for that one. In that scenario, what happens? Here we can see 23,500 has 5,000 maximum traded quantity and 23,650 has maximum traded quantity, and in turn we have both unmatched orders also same for the strike price. So how do we determine here? Here the factor comes in, which is the nearest strike price of the previous day close. In this scenario, let me consider 23,400 as the previous day close price. So what would be the nearest strike price here? 23,500 by default would be the nearest strike price for the opening. So this becomes 23,500 becomes the opening price for the current session. And suppose the previous day close price is around 23,700. Then 23,650 would be the nearest strike price, which is closest to the previous day close price, and that could become the opening price for the current session. So this is how this pre-open market actually system works, and this is how it is calculated. And this is same for all the segments in the equity segment. This is same. This is whether it is for the Nifty, whether it is for the equity individual scripts or whatever it is. For whole equity segment, this is how the pre-open market order is specified or determined. So coming on to the third and last session of this video, that is who can trade into this pre-open market. See, this is pretty much sure that by and obvious the pre-open market trading session is by default closed by all the brokers in India. What happens, these newcomers and beginners trading into this pre-open market with very less volumes and high volatility would end up into the chaos of the stock market. So in order to avoid that one, this is by default it is this segment is deactivated into the once demat trading account. So to activate that one, you can just place a special request to the broker and get it activated, and you can trade accordingly into the pre-open market. But you should have a brief idea and understanding and how this pre-market works and what is the motto behind it and how does this actually work. You have a brief idea, then only you can trade and make some profit out of this pre-market trading session. So I hope I have clarified all the points relating to this pre-open market and its implications. So meet you into the new video. Till then, take care and goodbye.